Were the markets ever really efficient and rational? If the efficient markets theory has lost its usefulness, what guidelines can investors follow? Well, our first guest is a WealthTrack television exclusive and follows his own investment map. He is Robert Kleinschmidt. He is CEO and Chief Investment Officer of Tocqueville Asset Management, where he runs the flagship Tocqueville Fund, which is highly rated by Morningstar for its successful contrarian approach. And we are also welcoming back global investor Jerry Sensor, who is the CEO and Chief Investment Officer of Institutional Capital, which specializes in large-cap value investing. He is lead manager for all of their funds, including the mainstay ICAP International Fund, for which he was named Morningstar's International Fund Manager of the Year in 2005. And our third guest is a newcomer to WealthTrack, but not to financial news junkies. He is Justin Fox. He's the economics and business columnist for Time Magazine and the author of the critically acclaimed book, The Myth of the Rational Market, a chronicle of the people and ideas that created today's financial marketplace. And we never stop to thank them. Welcome to all of you. It's great to have you here. And Justin, it's a terrific book. And I just told you I've read several chapters in it. It definitely is fascinating. But my question to you, we're going to start with you. Is the efficient market theory that the market essentially gets values right wrong?
It's probably approximately right in this very loose way over time. But on a day-to-day basis, yeah, it's probably wrong. B, there's no way to tell whether it's right or wrong, and so, yeah, it's wrong.
All right, the myth of the rational market. It better be wrong, since that's the name of your book. All right, you know, Robert and Jerry, we have two active managers here who have beaten the markets over the last 3, 5, and 10-year periods at least. So right then and there, they've already found inefficiencies in the market. But you two would be running index funds if you believe in the efficient markets theory. So is there any validity to the efficient markets theory for the rest of us, mere mortals?
Well, I don't know. I might be, teaching economics if I believed in the efficient economic theory, but I wouldn't be running money on Wall Street. That's for sure. I think in our case, and for investors who look at the world like we do, and we look at it from a very contrarian point of view,
right,
you have to play off of what is in the market, and you have to start with the assumption that this consensus view may be right, it may be wrong, but it's going to change. And so you have to think about how it's likely to change and where the risks are associated with it changing or not changing. So we take the point of view that similar to what you said, that it's never right for us. That the time period in which it is efficient, if that's true, is such a limited time period that it isn't the same time period as our investment horizon is anyway. So it's sort of a meaningless concept.
And yours is a longer term time horizon. Right, an average holding period for a stock in the Tocqueville Fund.
Well, 4, 5 years.
Okay.
So it's not even a relevant question to ask whether it's sufficient in that context, because what we're trying to do is figure out how the consensus is going to change, or you call it something different, how the efficiency is going to change to something else. So that's the way we invest, and I think that's probably the way a lot of value investors invest as well. So it's not terribly helpful from our point of view to look at it from the point of view of what's the efficient frontier for these stocks. It doesn't matter.
Jerry?
Well, we don't believe that the markets are efficient. I mean, the markets process information on a daily basis, and they do that in a pretty efficient way. But we think that there are inefficiencies that we can exploit over time and do so in a very consistent manner. And that's the way to generate good long-term returns, because you have to apply some degree of consistency or else you won't be able to provide good results.
So explain the fact that the majority of active managers do not outperform the markets. I mean, you two are exceptions, which is why you're here in WealthTrack. But so why, if the market isn't really efficient and you can, mine the inefficiencies, why do so many people fail to do it on a consistent basis?
Well, I wouldn't say it's easy, but I think there are a lot of elements to doing it. First, we feel that we've got a group of people at our firm who have been in the business for a long time, understand the companies and industries that they follow. We pay a lot of attention to valuation. We try and be very disciplined about our process. And we look for very specific factors for individual stocks that we found historically give a good leg up in generating good returns. So there are a lot of elements that go into the exploiting the inefficiencies that are there.
All right. So, you know, from an individual investor point of view, Justin, why do I care if the markets are efficient or rational or not? Why does it matter to me?
From an investor point of view, and for a lot of us, it actually doesn't matter that much, because the reason, I mean, the simple arithmetics of why most mutual fund managers, most professional managers fail to beat the market is because these days the market is mostly professionally managed funds.
Right.
And as a group, they are the market. So as a group, they're going to have the same return as the market minus whatever their costs are. And so, of course, professional managers as a group are going to underperform the market. So from the perspective of an individual investor, if you are confident in your own investing skills and have some reason to be confident, or you've found a manager who you're confident in and don't think their outperformance is just luck, go for it. Beyond that, I mean, that, to me, the case for index funds has nothing to do with how efficient or inefficient the market is. It's just, if you don't know that, if you don't feel confident that, okay, I got a plan here, you're always better off going to the lowest cost option, because then at least you're getting the market's return minus less of a fee than you'll get at your average mutual fund.
What do you think about that?
I think it's a very close to an argument for an efficient market thesis, so I'm not so sure that I agree with you that the market is dominated by institutional investors. I think that the key to outperformance is to not get caught up in the moment. There's so much information thrown at you. It's noise, really. But the temptation to act on it or to do something with it, all these things that make the market efficient are these actors acting immediately on the latest bit of information. And I think that from a point of view of being a good professional investor, long-term investor, is that you don't get caught up in the noise. You have enough experience and enough confidence not to let that stuff bother you, because it really isn't important in the long run. But it does, if everybody is acting on the plethora of information that comes in every day and acting on it in more or less the same way, there you get, I think, a certain kind of efficiency, but also built-in underperformance.
Right.